if you look across all of tech, so call it 500 to 600 public U.S. listed tech companies, there's only 13 that are expected to be growing north of 30% in 2025.
Wow.
There's like 25 expected to grow north of 20%. So there is massive scarcity value for growth stories in the market right now. And the IPO market has typically been the source of those growth stories, and it hasn't provided that. And so there's a ton of pent-up demand.
All right, welcome back to OK Computer. I'm Dan Nathan. I'm joined by my good friend, Jesse Chasse. He is the head of Tech ECM. That would be Equity Capital Markets at RBC Capital Markets. Jesse, welcome back to the pod.
Dan, always good to see you.
Yeah, this is fun. You and I had a lot of time together last week. Again, you held your TMT conference here in New York City. Probably about 200 or so companies presenting, maybe upwards of 800 investors in the rooms. Great conference, a lot of good energy. I think what I took away, and I'd love to get your perspective on this, is like the vibe of the presenting companies seemed very upbeat. So we're going to hit that. We're going to hit valuations. We're going to hit really where the IPO market is right now.
It's back, baby.
We're
back.
Yeah, we're back. All right. We'll talk about some interesting debates that I heard amongst some of the private company investors, especially at a dinner that you guys held. I thought was really interesting about, private for longer. What are some VC prerogatives? What do the capital markets look like, both public and private, heading into the new year? What does deregulation look like? So all of the above. Let's start with the TMT conference. Again, like TMT, kind of goofy, tech, media, and telecom. I think it was very, very heavy tech. Obviously, AI was a pervasive theme throughout.
Can't escape it.
So let's talk a little bit about the mood. You see, I want to say maybe 10 companies a week in your normal course of business. That could be here in New York. You're flying all over the country. What was it like to have all those companies in one place, last week, and what was kind of the vibe?
Yeah. So it's our marquee public company conference, but as you said, we also had about 20 private companies there presenting. So a really good mix of sentiment from public market, private market, both companies and investors. I'd say for the first time in a few years, there was quite a bit of optimism about what next year could look like. I think some of that is driven by the fact that we're sort of behind the election and the excitement around what deregulation might bring for the broader environment. We're on the other end of this rate hike cycle, right? We're now in sort of...
are we, by the way?
Well, very good question. I actually have some views and perspectives on that as well. But we're at least cutting rates and not raising them, at least for the foreseeable future. And then we just sort of came out of reporting season. Which in software in particular, which has really been the most beaten down of the subsectors within tech, and in some ways viewed as uninvestable for the past few years, it's starting to feel better. Now, look, I think you juxtapose all that relative to rates and a 10-year that's actually also doing better or up and to the right since the election in that same period of time. And I think the questions on a lot of investors' minds is, has the growth trade or the sort of mid and small cap tech trade finally decoupled from rates and started the trade on optimism around the macro economy? And how sustainable is that? And I think, you talk to investors and you ask them that question around how long can rates march higher while sort of software stocks march higher. And the answer is, look, it finally feels like we might be in a market where we're in an earnings upgrade cycle next year in software. And that's really what we need for multiples to break out of this range that they've been sort of stuck in for the past 2 years. And in the past 3 or 4 weeks, we've finally seen that started to happen.
Yeah, so it's interesting that you mentioned the relative underperformance of software over the last kind of 18 months. I think that's what you're getting at, especially as kind of generative AI has been like the prominent theme. And we can get to a little bit. There was a really smart participant at the dinner we just mentioned talking about some of these SaaS models and how there are lots of headwinds, afoot. But if you look at since the election, software, the IGV, right, the ETF that tracks, it's up about 15%, while the SMH, the ETF that follows the semiconductor index, which is heavily driven, obviously, by NVIDIA and Taiwan Semi, they make up like 35%. It's kind of stuck in the mud. It's down about 13% since its highs and has gone nowhere really since the election. What does that speak to me? a little bit about how investors are looking to broaden out a lot of these tech themes. So I'm curious, when you think about software, it's been a difficult period. Usually we see lots of M&A, right? And I guess the point is reasonable valuations, just not that sexy as it relates to their integration of generative AI. Does that make some sense?
Yeah. No, look, there's a lot in there. I think the first thing I'd say is I think you'll continue to see mega cap tech. And semis in particular be a source of funds as the software trade takes hold. And as I've said, the biggest challenge in software is that we have not been in an earnings environment where investors think there's a lot of upside to estimates. And in that environment, without sort of a real move lower in rates, it's tough to see why software would catch a bid. I mean, if you think about the headwinds software has had in the past 2 years, it's been sort of meaningful and consecutive, right? We had the cannibalization of forward growth that took place with the pull forward during COVID. That played out for 2 years. We had, an enterprise customer, quite frankly, that has been worried about a recession for the past 2 or 3 years. Yep. The recession that never came, quite frankly. But because of that, they took down spend. And then this year in particular, you saw a lot of budgets freeze around questions on AI, right? Why go procure new software when maybe there's some AI native solution that we could either procure or build in-house? And I think those questions have been another headwind for AI budgets, or for broadly for enterprise spend budgets in general. And that has been the biggest headwind to growth. And I think the biggest question on investors' minds around that rotation trade from semis and mega cap tech into software as we head into year end is it just a trade playing for a Q4 budget flush like we saw last year, where you'll have a solid Q4 and that trade then fades in January and February, which is exactly what happened last year. It was a bit of a head fake. Or are we in a durable cycle of earnings upgrades in software whereby you can invest in the asset for the next 12 months rather than just sort of the trade into year end? And frankly, that's still an open question, but that's the type of environment we need for the capital markets to be functioning in a better way around particularly SMID cap tech.
SMID, small, medium. So one of the things that I think is kind of interesting, and you just kind of keyed on this a little bit, diversification from AI. AI first stories, and NVIDIA would be one of them. Sure. You could even throw Taiwan Semi in there because they make 85% of the high-end GPUs. That basically, that's the market share that NVIDIA has. A story like Microsoft was a great example. It encapsulated a lot of those themes, right? Since that OpenAI investment, not the initial one, but the big one in the start of 2023, $10 billion. So you had that. They were in the catbird seat to some of the models. They were obviously going to have their public cloud. Azure was going to benefit from that, right? You saw lots of multiple expansion in the name. I think it's trading at a multiple it hasn't seen in a very long time, low to mid 30s PE. But this thing's been stuck in the mud. It's underperforming the Nasdaq and the S&P, and you don't have to opine on that. It's up 11.5% on the year versus a Nasdaq that's up about 26%. So I think that narrative holds true, and it's playing out right there in a stock like Microsoft, relative to the fact that the IGV has just had this parabolic 15% run in the last few weeks or so. So let's talk a little bit about the backlog, and we'll get to software in a second because that's one that you make it sound like it's loosening up a little bit. What do you think it looks like? Just give us some data on 2024 in the IPO market.
Look, we've had a better year than 2023, which isn't saying much, right? There were 8 tech IPOs
in 23.
In 24.
Okay.
In 23, there were 3. Your typical year run rate in tech is, call it 30 to 40 IPOs. So better, but nowhere near what you typically see. And I think, quite frankly, the biggest factor that has kept a lot of companies out of the market has been this issue that we highlighted, which is a broader macro environment that's tough, which makes it really challenging to forecast your business. And thus, you're not going to go into the public markets if you don't have a great grasp of what your forward financial profile looks like. And so that's been the most significant challenge. And the other challenge, quite frankly, has been, as great as this year has been in broader indices, if you just look at median stock price performance for small and mid-cap stocks, it's been flat.
Yeah.
Prior to 2 weeks ago, it was negative. We were down on the year for stock price performance in small and mid-cap tech. And a lot of us get confused by the broader headline multiples, which are driven, most of them are market cap weighted, so they're driven by the biggest names that have been winners. And there's also asymmetric skew, whereby the biggest winners draw up the averages. But if you look at the medians, it hasn't been the best multiple environment. And that is the other thing that I think needs to change for the market to open up next year. I have gotten meaningfully more excited in the past 3 or 4 weeks about what the IPO market might look like next year. I go back 4 weeks ago, there was 8 additional IPO opportunities that we're chasing that I think will very likely be in the market in 2025. And so it does feel like it's starting to reopen in a pretty meaningful way. I do think what's interesting, though, is you think about the complexion of the companies that might go public. Everyone's been waiting for these large software businesses, the 30, the 40 billions, the Databricks of the world. Those don't feel like the companies that are actually going to go public
next year. They keep raising lots of money in the private markets.
They don't need to. Yeah. They've got access to as much capital as they'd like in the private markets. They've got the ability to return capital to both employees and shareholders through tender offers and such. And so those companies don't feel like they're set up
we got to hit that theme in a way, because if that wasn't loosening up the ability to kind of raise capital, or at least get existing investors or employees capital, right? You would actually have to see, you would see more IPOs, because that's the traditional exit, how you return that capital.
It's a refresh cycle of capital, which you need. But there are a cohort of large-scaled fintech businesses that I think will get public. There will continue to be sponsor-backed IPOs.
All right, explain the sponsor-backed IPO for a second.
Yeah, sure. So, there's sort of 2 worlds that I live in. The first is the financial sponsor world, and the second is the venture capital world. And the growthier assets tend to be venture capital-backed assets. And then the assets that sort of, are reverse LBOs, were public and got taken private for some love and help, are the typical financial sponsor-backed IPOs.
Which are private equity companies.
Backed companies. And that market, I think, will continue to be a source of IPOs in 2025.
Yeah, so you sit in a really interesting seat. So not only do you run a lot of the IPO process, or trying to kind of win that business, right, from private markets, you also cover venture capitalists, okay? So you're trying to get a sense of what their prerogatives are, and the companies that they're most optimistic about going public. Because oftentimes it will be the VC firms pressuring their portfolio companies to figure out what is the exit. If you're a VC company, you're generally working in 5 to 7 years for some sort of exit. You have to return that capital to your LPs, and then you want to recycle it, and you want to start looking at the next stage. So again, that's been really hard for a lot of these companies, the VCs, who raised a lot of money in 2020, the back half in 2021, and they put a lot of money to work. But then you have this valuation issue. So I want to get a sense. So you sit on one side where you talk to private VCs, private companies, and then the other side, you are dealing with a lot of the largest capital pools in the public markets, right? And they have certain prerogatives. And so, at the end of the day, those public market investors, they want to see lots of issuance. It gives them the opportunity to basically add some alpha to their existing processes, because you can't just buy a large cap name and expect that after it's appreciated so much and had multiple expansion to be that alpha going forward. You need to find some new stories. Is that correct?
That's right. Yeah, we've talked about for a long time around the drought in the IPO market is a supply issue and not a demand issue. I mean, we were with some of the largest small cap investors in the world last week, and they have a mandate to buy small cap equity stories. And there's frankly not a lot left for them to choose from in the public market, particularly those that are, showing the type of growth that a lot of those investors like to look for. I mean, this is a wild stat, and I look at this all the time, but if you look across all of tech, so call it 500 to 600 public U.S. listed tech companies, there's only 13 that are expected to be growing north of 30% in 2025. Wow. There's like 25 expected to grow north of 20%. So there is massive scarcity value for growth stories in the market right now. And the IPO market has typically been the source of those growth stories, and it hasn't provided that. And so there's a ton of pent-up demand. I do think public market investors, it's interesting. We had a panel last week where we had a private equity partner, a venture capital partner, and a small cap public market investor. I do think public market investors think all of the gains have been pulled forward such that the private market investors are benefiting from the gains. And the public market investors no longer get to participate. So they're looking for IPOs as a source and ability to participate in some of those gains. And it was particularly acute around AI. The question came up on stage around how do you think about investing in AI for the next 12 to 24 months? And the private market investors, as you would expect, were super excited, right?
Because they're still deploying lots of capital crazy valuations.
But there was this sort of existential panic that existed from the public market investor, which is, wow, the same thing's happening again. You're driving the private market valuations up so high such that I won't benefit from any of the actual earnings upside as it relates to AI. And in fact, all of the application software companies I currently own in the public markets might actually get taken out based on new AI native technologies that sort of act as a source of depression against those earnings for the public companies. And so that was a palpable distinction around the AI trade between the private and the public markets.
Oh, it's funny. So if you just look at one of the last very large and hot IPOs that came at the end of 2020, that was Snowflake, right? And so obviously this is not an application software name. It's more towards infrastructure. And, they've been telling a story about AI and the integration and how that's going to help their customers. And at one point earlier this year, the stock was down nearly 75% from those late 2020 highs. From this year's highs at some point in the recent past, just a few months ago, it was down like 50-some%. And here's the one point I just want to make is that this speaks to how desperate public market investors are to find some of these kind of uncovered stories. And again, this one's been left for dead. It was up 35% after they reported their earnings the other day. So just think about that. That actually, I think, helps make your point in the public markets. But then let me just ask you this. If there's a lot of euphoria and enthusiasm about what's going on around generative AI in the private markets, and it seems like you just addressed that, how do those companies grow into those valuations? Because, like Amazon's a great example. They keep investing in Anthropic, $4 billion here, $4 billion here. Yeah. And you look at the way valuations skipping up. How do you bring a company like that to market, which on a multiple of sales is crazy, right? And it may be the story that has the most, I think, room to run. I don't know. You know what I mean? It's a way to catch up to OpenAI. But how do you deal with that back and forth a little bit? Because that seems like a really tough one.
Look, I mean, the truth is we don't know. I think it's one of the biggest concerns as you talk to investors is, are we making the same mistakes we made in 2021 in setting ourselves up for a cohort of private companies that have valuations that are unsustainable and can never get public?
But at least there's not the SPAC exit because think about that, because in 2021, that helped bring a lot of crap
Those
to the
companies
market.
got public, right? The difference is they didn't stay private, right? Like in 2021, as I said, typical run rate for tech IPOs is 30 to 40.
Yeah.
You had 100 tech IPOs and another 100 companies get public via SPAC backends just in the tech space alone, right? And so that's certainly different. I think in a lot of ways, the public markets are acting as the sort of gardener against some of this. And it's also why they've decided to invest their money in the sort of picks and shovels AI plays that are in fact seeing real earnings growth, right? Like, say what you want about NVIDIA's multiple, but if you look at the earnings growth that's come alongside of that, it's been real, right? It's been real for the cloud providers, for, as you said, Azure, Microsoft, et cetera. It has been real. So look, I think private market investors are doing what they're supposed to do, is they're taking a diversified approach to investing in what I think we all collectively believe is the biggest secular tailwind that's come to, tech investing since software or the internet. And so we'll see. It's tough to see how that plays out, but there's absolutely plenty of excitement.
We're
around
definitely seeing more pressure though on a lot of these private market generative AI stories. I saw one today. They just got a new CEO and laid off half their workforce. You're starting to see, the winners and losers kind of play themselves out a little bit, and it just seems like, right now it seems a bit like a winner winner take all when you just consider like an OpenAI and Anthropic and a handful of other names. But I want to get to one thing I thought was really interesting. So again, this goes back to this dinner. I think there was probably 8 or 9, private tech CEOs, okay, a handful of bankers, you and your CEO actually of RBC. And I just want to be really clear on this. For a lot of our listeners who are not paying attention here, RBC is the largest company. Now, granted, they are a sponsor of this fine podcast, okay? So RBC's market cap near 180 billion is just behind Goldman. It's above Citi, and it's nipping on the heels of Wells Fargo. So just for some of those folks who are not familiar with the bank, it's big. It's the largest institution in Canada, but it's also nipping at the heels of some of like the preeminent financial companies here in the U.S. So your CEO was at this dinner, and you got kind of animated. One of the CEOs of one of these private tech companies asked you, so what about that notion that you need $1 billion revenue run rate to go public? And I know you've been publishing on this. I think we hit it on the last pod you were here.
Sure.
But break that down, because you got all hopped up. Maybe it was the wine. I'm not sure. But it was something that actually most of the founders in there were really interested in your answer.
Yeah, it's just not true. I really don't know where this sort of narrative has come from. And, there can be groupthink in the Valley where some narrative takes hold and then all of a sudden everyone believes it.
But it's not coming from the VCs, because the VCs want to see these companies come to market.
It might be. I mean, some of those VCs also don't want to see those companies come to market at down round IPOs.
Okay.
Right. So there might be a little bit
of
that.
So just explain that for a second. So in late 21, maybe to the beginning of 2022, there was still some very high valuations being, paid in the private markets.
That's right. And those valuations marked up the performance of those VCs on their books. And if many of those companies were to go public today, they'd be going public at valuations that are below where those valuations were marked. And so, maybe there's a little bit of a desire to continue to let those companies grow into previous valuations and to not lock in those down rounds. I don't know. I really don't know what the driving force behind the narrative is, but it's definitely a narrative, which is you need $1 billion of revenue to go public in today's market.
And what sort of visibility towards profitability, let's say, if you were on that $1 billion run rate?
Yeah, you need to be profitable is the other thing people say. But look at, just pick an IPO from this year, OneStream. Great business, Office of the CFO software business. On a forward basis, $500 million of revenue, growing 20% and break even, right? That's a business that most people will tell you, oh, that can't get public in this market. Got public at a really healthy multiple and has traded very well. So this narrative is just not true. Like, look, investors are inherently greedy. They're looking for returns. So if you take a business public that they're excited about, that's going to generate alpha in the aftermarket, they will invest. They don't care what size it is. Now, there's sort of minimum thresholds from a liquidity perspective that do matter, right? Like, I don't think you want to be sub $1 billion in equity value, but there is absolutely a cohort of small cap investors that, as I said, are looking for new investable assets in an environment that's pretty scarce. Now, we went in and I was trying to sort out where this was coming from, and we did a lot of work and sort of ran the numbers. But if you look at things like correlation between revenue scale and multiple in today's market, 0. If you look at things like correlation between revenue scale and post-IPO performance for any cohort of IPOs over time, correlation is 0. There's tons of examples of highly successful businesses that got public at $100, $200 million of revenue scale. And as I said, there's tons of capital chasing these stories and tons of scarcity value for these stories in the public markets. And so it's just not true. Look, I think part of the other thing that's driving it is you've got a cohort of founders and management teams of tech companies that live in the Valley that got public in 2021 and they've had a tough go at it, right? Their multiples have been compressed. The stock prices have traded nowhere but down. But that was a function of getting public at a point in time at an unsustainable valuation, not a function of getting public too small, right? And so that's, I think, the biggest distinction that you need to make. I think there's a lot of benefits to being a public company, right? We talked a little bit about this about the dinner as well, and it actually, I think, sparked some arguments at the table because people feel pretty strongly about this. But, if you think about what increases your odds of long-term viability, being a public company, I think, is a damn good reason for that.
Yeah, so let's talk about this though, because again, there's usually this kind of dual track, right? If you're starting to prepare yourself to go public, you might also consider what are the opportunities as it relates to M&A. And you just spoke of this kind of sponsor-backed sort of thing. That's not private equity at that point. So it would be some strategic M&A, right? And so now we have this idea that the next 4 years is going to face some, major deregulation. It's one of the reasons why you weren't able to see, no one went out of their way to try to buy OpenAI 2.5 years ago. They knew it would never happen. And then I'm sure OpenAI were like, listen, we don't need this. Like, we got the product, we got the interest in it, we have the great staff running it, those sorts of folks. And so what does the M&A environment look like, I guess, from a strategic standpoint and as a possible exit for a lot of these companies that kind of fit the criteria you were just talking about?
Yeah, look, I think the biggest tailwind to that getting better, quite frankly, is the Trump presidency, deregulation, Lena Khan losing her seat, and perhaps, and this isn't certain, right, because the vice president has had some pretty different views on this, but perhaps a better regulatory environment for M&A.
Which means for large cap tech and their ability to kind of make acquisitions in the private markets.
That's right. But the question is are those companies really looking to do M&A? Are they looking to deploy their excess cash into CapEx to chase AI, whether it's data center build-outs or private AI native companies that they'd rather spend their money on that are sort of smaller and earlier stage? I think there's still a big question as to whether or not those strategics will actually want to engage in M&A in the ways we're thinking about. I do think the financial sponsor community is a source of buyers for M&A will continue. I think they'll have some wins in the IPO market next year, which will refresh some cash. I think they've had a lot of success, quite frankly, of buying companies at the right price, getting those companies fit and taking those companies public. And so I do think that's where the majority of the M&A bid will continue to come from, is the financial sponsor community. The question on large cap M&A that everyone's so excited about coming from strategics, I think that's still a very open question.
Well, think about this, okay? And this is one that Guy and I have kind of made the point of pointing to because the stock has had this crazy performance, and this is Palantir. It's up nearly 300% of the year.
40 times sales it trades
okay.
at.
Well, this is where I'm going. It's got a $150 billion market cap. It trades at next year 40 times sales that are expected to grow at 25%. Earnings are expected to grow at 22%, trades at 140 times that. And, gross margins, 82%, fantastic, okay? But again, if I'm Palantir, and by the way, they're right below us in this building.
And they're listening.
Yeah, they are, I'm sure. But why wouldn't you use your currency, right, to go out and buy some stuff that you think will kind of diversify your revenue stream or something that you can cross-sell, or, you know what I mean? Because all of a sudden now we were thinking about this about 6 to 9 months ago, that the in the public markets, the valuation accrual in market cap terms were the Mag 7 for the most part, right? And it's broadened itself out considerably. Palantir is probably the best example, but it's also probably the best example of an egregious valuation that they pulled forward so much, whatever financial performance they might have, as far as the operating company in market cap terms, because I don't know how, think about the sort of revenue base that you would need to kind of start to get and the growth that you would start to get to justify 140 times earnings and 40 times sales.
Yeah, look, it highlights the scarcity value for one, growth stories, and two, ways to play AI in the public markets, right? And in a lot of ways, as you said, benefited from that sort of swing of the mega cap tech trade and even the semis trade. And it's happening not just at Palantir, by the way. I was looking this morning, there's now something like 25 software companies trading north of 10 times sales, right? And so I do think winners and losers are emerging. And I think this idea of dispersion, where you have plenty of companies that trade at really high multiples and plenty of companies that are sort of left for dead, I think that will continue to happen. Particularly as the market starts to trade more on macro and not just on completely on rate sentiment.
Right. And one of the things I'll just say, going back, I know you were probably in middle school back then, but in the late 90s when I started my career, there was a tremendous amount of optimism, obviously, around the internet. And at the time, it was focused on these fast-growing companies. No one really knew what the end markets were going to look like, what the return on the investment was going to look like if you were deploying these sorts of strategies. Let's say you were what they called is like a bricks and mortar company company versus, digital. And you had these multiple years in the late 90s where there was 25% plus gains in the markets. It was being fueled by the enthusiasm in and around this new technology. So, here we are in our second consecutive year, assuming that, let's say we close right here at, the end of 2024 of two multiple 25% years in a row, right? There's tremendous enthusiasm, which has really been accrued to a narrow group of companies about AI. So the idea, my view is that the next trade of generative AI is going to be how it kind of works its way into other industries, whether it's healthcare, whether it's industrials, that sort of thing. So you might see multiple expansion in those for the companies. They're getting a return on an investment, right?
Yep.
So like that to me is probably the next leg of this trade. But then I think about where are the use cases right now, you know what I mean, that'll justify these multiples, and that's the one thing that I think Microsoft is underperforming this year, why some of these other names that have invested so heavily in either the models or the data centers, you know what I mean, like they may face a period of digestion next year.
Sure. Look, a couple things I'd say. So the first thing is, I think the difference between this market, and I hate to be the this time is different guy, is the majority of those gains that have driven the 20% move in the indices have really been concentrated in large cap companies with high quality earnings.
Well, NVIDIA is your example that you're going to go to, and NVIDIA is 25% of the gains in the S&P 500 this year.
Yeah, right. Now, we can argue about how fragile that is as it relates to the broader market, right? It creates certainly some fragility with that concentration. But I do think it's tough to argue that multiples have gotten out of control, particularly relative to where they were at the beginning of the dot-com bubble, right? Now, that's not true in the private markets. I do think there's a lot of businesses that have been funded at unsustainable valuations. And we're starting to see that shift a little bit in the last month or so. We have a mutual friend who's a founder of a venture firm focused on AI. And we were sharing an Uber to our dinner the other night. And he basically was just like, I'll tell you what, like, I'm thinking about just going and starting my own business because the cost of capital to fund AI startups is great. But as an investor, I just can't find any businesses that I'm interested in investing at the valuations that they want. And so, look, I think this period of disillusionment that you're referencing that we're likely rolling into is going to be more sustained and more acute in the private markets than it might be in the public markets.
Yeah, and the one thing I'll just say is that if we do see this like influx or this massive, increase in IPO activity over the next year or so, and especially if some of these big names were to go, if it was a Stripe or an Anthropic, and Stripe is much more likely to do that than an Anthropic or OpenAI, anytime soon. But if you brought some of these companies to market, you are going to see some of these early large cap beneficiaries in the public markets. They're going to take maybe not just a pause. They're going to come in, like the way that Microsoft has acted very heavy, because you're going to see investors, to your point, they're greedy. They're looking for faster growth stories. That we've seen that in other periods.
Well, it could be really interesting, right? Because we've had 2 years in a row of a really strong equity market, albeit concentrated, and no IPOs.
Yeah.
What we might have next year as the market reopens is those companies are a source of funds for these new IPOs. So you might be in a market where the broader indices are compressing, but the IPO market is gangbusters, which is just this weird setup that we haven't quite frankly seen.
All right. So one last thing before we get out of here. You're a great friend, but I also think of you as a very talented tech banking professional. But you and I in September, we're in San Francisco. I think you were meeting clients. I was out there for a conference and we were doing a bunch of stuff. And all week, you and I just kept on, because you and I were hanging out, drinks, meeting folks and the like. We're just taking Waymos. And I thought, this was like an amazing, amazing experience. I don't think I used, the only Ubers that I used was to and from the airport because it's geofence, that sort of thing. And so one night, and maybe we had a couple dinners, we had a couple drinks, and we were getting out of a Waymo, and I don't know why, you wanted to get out before we got to the location, and we get into the next place, and all of a sudden you go to pay for something this is, by the way, this is such a rookie move. All these people who keep their IDs and their credit cards on their iPhones, like single point of failure here, people. So we get in there, you're pulling out a card, and you're like, where's my phone? And you have two phones. both phones were gone, and your whole wallet, which is attached to your phone. And so you had to deal with some high-tech issues there. And it was like 11:30, midnight, and I just basically gave you my cell phone, and I gave you a credit card, and I said, you're going to have to deal with Waymo on this one. So how did that whole thing go down relative to, let's say, a driver being in a car when you lost all that stuff?
Yeah, we were spending the whole week talking about how cool Waymo was and why would you ever take an Uber, and then we found out.
Yeah. What do they say, that F around and find out?
That's
exactly. What you did in a Waymo there.
I must say, you do not miss an opportunity to bring that story up. And you also didn't miss the opportunity to have a very fatherly comment, because you're much older than me, right?
Much older.
A lot older.
Much older.
Could be my father's age, right?
Well, maybe not. But.
So you did not miss the opportunity to kind of yell at me the next morning.
Well, you're still doing that. And by the way, this was at midnight, and you had a 10 a.m. flight from San Francisco to Houston for a pitch.
Yeah.
And you were not sure you were going to get there, because not only did you have a form of paying, you didn't have a form of ID to kind of suggest who you were at the airport. But you made it all happen. I was very impressed with it.
Made the flight, crushed the pitch, all thanks to you.
And it's a great experience. I love the Waymo thing.
It's cool.
I'm really
the
fired
future.
up for it.
Right? I'm dorky enough to show people videos, because on the East Coast, people don't actually know that it's happening out there.
So it's in LA, San Francisco, Austin, and Phoenix.
That's
right now, right?
Yeah.
And so listen, one of the reasons why, Tesla has gone from $220 to $350 in a few weeks is because the idea that Musk is very involved in this transition and might be in the new administration, he's going to get rid of a bunch of the regulation that's kind of held back their robo-taxi ambitions.
Yeah, well, it's funny. One of the interesting hot takes from the conference last week was that Musk either gets bored of or booted out of the Doge within 6 months. So.
Probably. But for him, he will probably have accomplished everything that he wanted to do.
That's right.
And the one thing I'll just say lastly on Musk, I'm not a fan of the man. I'm not a fan of how he operates his businesses. He just acts however he wants to act, regardless of the laws and this and whatever. That is what it is. But him being involved in these industries, whether it was EVs, whether it is SpaceX, Starlink, that sort of thing, he pushes the boundaries of what people think is possible in those industries. If you were to have a roadmap towards robo-taxi because of deregulation, he's going to make that industry better. Is that fair to say?
Yeah, and they're noble endeavors as well. Broadly, I think it's easy to argue with the man, but I think the endeavors he's embarking upon are problems that are really hard to solve.
Except the Twitter thing, to be honest with you,
sure.
like the free speech thing. But the other ones,
free speech is a noble endeavor.
Yeah, but you look at that and you say to yourself, what is he actually doing from, using that platform? But whatever, we don't have to kind of debate that.
Fair enough.
But I think his entrance in a meaningful way to the robo-taxi kind of movement would probably be one that ends pretty well for consumers.
Totally. And it's also a good example of sort of large caps using their balance sheet to fund pretty exciting stuff at a good cost of capital, right?
Yeah.
Waymo wouldn't have gotten where it was if it wasn't for all the money dumped into it by Google.
Yeah.
So.
No, that'll be a great 2-horse race. I hope it happens without a whole host of speed bumps along the way, because one of the issues is safety, right? And so again, all right, listen, Jesse Chasse, I really appreciate you being here. We covered a lot of ground, and I think next year is likely to be more interesting from the standpoint we're going to get to focus on different stories, new folks who are leading these companies and how they interact with the investor base and the like those. So
I think there'll be an excuse for me to come up here more often.
Fair enough. Let's do it, baby. All right. I appreciate it, Jesse.
Thanks, bud.